As a dividend investor looking for the next big stock for the future that also pays a decent dividend, you are most of the time left searching for quite a bit. Sometimes there, however, are a few exceptions, like for example the chip industry, which seems to be providing a ton of long-term growth. Here one would stumble upon Intel, which as of recently has been appearing to be quite beaten down. But is this actually justified? Does Intel have what it takes to make a huge comeback? And is Intel at its current price point a buy? This is Might As Well Invest, becoming smart money. On a quick side note, the YouTube algorithm has recently stopped pushing my videos. So if you want to help me out with no additional cost whatsoever, I would appreciate it if you could smash the like button, drop a sub, or maybe even share your take on Intel in the comments down below. Intel, which was founded in 1968, is one of the, if not the leading chip designer / manufacturer. As one could imagine, this also gives a hint that Intel might be one of the bigger players when it comes to its valuation, which with its current market cap of about 220.6 billion is in my opinion more than confirmed. However, this valuation can be attributed to far more things than just Intel's market position, like for example the company's revenue of about 77.9 billion. So in order to get a rough understanding of what is actually making Intel money, let's break said revenue down a little further. Generally speaking, Intel offers two business segments, the biggest one being the PC-centric business, with about 40.1 billion in revenue. And last but not least, Intel also offers the data-centric business segment, which contributes about 37.8 billion in revenue. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders or are planning on becoming such, and that are the distributions to shareholders. Intel currently returns capital to their shareholders through a dividend and to some extent stock buybacks. But let's start out by taking a look at the dividend, which currently sits at about $1.39, equaling a current yield of 2.54%. Pair this with about 7 years of dividend growth and a fairly small 5-year growth rate of about 6.26%. When it comes to stock buybacks, these are a little bit harder to track. If we however take a look at the most recent results, we can see that these set at about 13.3 billion. To now figure out how sustainable said distributions are, let's take a look at the numbers. Generally speaking, we are able to spot a free cash flow trend that is showing decent growth with a minor bump in 2017. If we now put this into contrast with the overall distributions paid out by Intel, it is safe to say that these are quite sustainable, but don't have too much room to grow, as they would fall into the unsustainable territory quite quickly. Therefore, I would personally say that you should not expect too much distributions growth in the future for Intel. Let's however take another look at Intel's financials in order to get a more detailed overview of Intel's finances. As per usual, let's start out with the company's balance sheet for the year of 2016, in which Intel's total assets sat at about 113.3 billion US dollars. These were made up by about 66.2 billion in equity, 25.3 billion in financial debt, and 21.8 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is done using Intel's debt and its cash position of about 5.6 billion, with which we get a net debt of about 19.7 billion. If we now compare this to the year of 2020, we can see an increase in total assets to about 153 billion. These total assets were made up by about 81 billion in equity, 36.4 billion in financial debt, and 35.6 billion in non-interest paying capital. Let's however again calculate the net debt just like we did for the year of 2016, with this year's cash position of about 5.8 billion. This time we get a net debt of about 30.6 billion, which is also a pretty decent increase. But let's also find out how sustainable the debt of Intel actually is and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which after some calculations leaves us with a sustainability factor of 0.94 for the year of 2016 and 0.85 for the year of 2020. This indicates to us that the debt situation over at Intel has actually improved and is overall in a really great spot. Alright, so since we now have the financials covered, what we want to do is get the margin of safety, as this will help us with getting the fair price per share for Intel. To start out with the upsides that Intel has to offer, it is worth mentioning the company's market position. Intel, which is also often called Chipzilla is the leading global chip manufacturer and designer when measured by revenue. This obviously translates to a status of being somewhat known and reputable to various customers, but also those ones looking to join the market as buyers. In combination with a growing market that is becoming more and more important in our modern day economy and society, this obviously sets up Intel for growing long-term demand. This in return leads to somewhat reliable revenues as well as growing shareholder value through possible distributions. Therefore, I will be reducing my margin of safety by about 5%. Let's now get to the brutally honest part though, and that is that Intel's list of upsides is extremely short, for which reason I will be moving on to the downsides. To start out with the probably less significant one, Intel is rather well known for not having the best track record when it comes to manufacturing chips. This can largely be attributed to things such as them not being able to meet production deadlines or just having manufacturing issues with the chips themselves. Obviously, this is not an ideal thing, as customers usually tend to listen a lot to reviews, recommendations, and so on from other customers. And as the famous saying by Warren Buffett goes, it takes 20 years to build a reputation and 5 minutes to ruin it. Therefore, it is safe to say that one walks on a scary path with things like this. For which reason I will be adding 5% to my margin of safety, simply due to the fact that I think the customer satisfaction for Intel customers isn't as high as it should be. Last but not least, and in my opinion most significantly, I want to mention that as of today, Intel is no longer the attractive chip powerhouse it once was. And that can largely be attributed to the company falling behind on the technical and also output aspect to their competitors AMD in chip design and TSM in chip manufacturing. A great example for this exact thing happening and impairing Intel's ability to grow its market position is the recent delay of their new server chips, simply due to the fact that these aren't really able to offer the same price to performance ratio as AMD's server chips, leading to, you have already guessed it, customers simply buying from their competitor AMD. And things like that are also the reason why in the big picture the rather promising Titan is actually not really growing in terms of revenue and is more so stagnating. Therefore, I will be adding 10% to my margin of safety, as I simply think Intel is at the current point of time giving away its market leader position. To now get the fair price per share for Intel, we have to take a look at the historic dividend yield. For the past 10 years, this set an average of 2.87%, thereby meaning you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of $1.39, a fair price to pay would be $48.43, which would mean with the current share price of $54.93, you would have to pay a 13.42% premium. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 2.87% and add my safety margin of 35% to it. This gives us our target yield of about 3.87%, which leaves us with a price to buy the company at of about $35.92. To sum it all up, right at the start, I have to say that I personally would rate Intel a sell, as I honestly think the downsides outweigh the upsides. The company has a lot of issues on their hands, which need some serious fixing that isn't done within 1 year or from one day to another. For which reason I also don't believe Intel is the turnaround story some want you to believe. Sure, the company isn't totally bad and still offers a rather reliable role. However, it is stagnating in a growing market, which usually tends to be a big warning sign.